Hello, this is George McAllister with Intuum, and I'd like to welcome our listeners to today's podcast session. We're pleased to have Doug Sherlock, Senior Healthcare Analyst for Sherlock Company, joining us today. Doug is here to give us his quarterly insights into the financial markets of health plans.
Thanks, George. In this podcast, we'll review the performance of the managed care industry for the first quarter of 2021 and year to date. We'll also discuss sector valuation indicators and operating trends. This will be an unusual presentation in that it is impacted by the effects of 4 new health plans added to our universe so far in 2021. This will bring the total of our coverage to 11 from 7 previously. Happily, this makes it possible to add a Medicare market segment to our universe of plans. As always, to assure comparability, we will only use comparable plans in trends, and that convention will be used in the body of this presentation. However, we do discuss the additional plans as a key environmental factor later in this presentation. First, I want to speak to stock prices and valuation for the continuously participating plans, that is, excluding the 4 newly public plans. As of May 18, stock prices for the publicly traded health plans are up by an average of 19% since the beginning of the year. Similarly, health plan sector market capitalization increased by 17% year to date. The overall increase stemmed from a broad increase across the plans. This compares to the 10% increase in the broader market measured by the S&P 500. The stock prices for all 7 plans gained ground so far this year, led by Cigna at 26.4%, followed by Molina at 23.1%, and Anthem at 22.5%. Triple S increased by 18%, Centene also increased by 18%, United Health by 17%, and Humana grew by 10%. Valuation metrics were all higher since the beginning of the year, with price to trailing 12-month earnings increasing by 21% to 19 times and price to operating earnings growing by 12% to 16 times. Price to projected 2021 earnings was higher at 19% to 16 times. Price to sales gained 9% to 2.75 times. Price to total member increased by 12% to 3,700, and price per risk member grew by 9% to 5,900. All rates of change, again, are calculated, holding the universe of plans constant over both periods. Since our last podcast in March, the average health plan stock prices are higher by 14%, with health plan market capitalization increasing by 13%. The S&P 500 gained 15% since March. Health plan valuation metrics all trended higher. On to our review of operating trends. For the first quarter of 2021, combined ASO and risk membership increased by an average of 8.5%, while increasing by 4.1% in total to 141.8 million members. By average growth, I mean the average of each plan's growth rate. Total reflects the change in combined membership of these publicly traded plans as a whole. Fully insured risk membership increased by an average of 11.7% and in total by 9.1% to 82.2 million members. For commercial plans, Anthem grew 11.2% to 17.8 million insured members. Medicaid plans experienced an average increase of 14.7% and a total growth of 16.7% to 22.1 million members. Molina had the fastest growth rate for Medicaid plans, 35.3%. Molina completed 3 acquisitions over the past year. Your Care Health Plan, Passport Health Plan, and Magellan Complete Care for a total of approximately 572,000 members. Molina also had year-over-year marketplace membership growth of 88.5% from 329,000 members to 620,000 members. Molina stated in its 10-Q that the growth in marketplace membership resulted from several factors, including strong product design and competitive pricing, better than expected natural attrition rates, and the extended open enrollment period, close quote. The proportion of total members served under self-funded ASO arrangements fell by 2.7 percentage points to 41.8%. On average, the plans posted a 3% decrease for this product, and ASO membership was down in total by 2.2% to 58.9 million members. Revenues for all plans increased by an average of 15.1% and in total by 10.8% to $170 billion. Medicaid plans reported $37 billion in revenues, an average increase of 29.4% and a total increase of 19.4%. Molina posted the largest percentage gains in revenue for Medicaid plans, up 43.7% for the same reasons as its membership grew. Commercial plans increased by an average of 9.2% and in total by 8.5% to $113 billion. United Health posted the largest increase to revenues, up by $5.7 billion to $70 billion in total. Premium rates for all plans grew by an average of 3%. Medicaid plans and commercial plans experienced an average premium growth of 4% and 3% respectively. Note that the premium rate growth does not adjust for changes in product mix, geographic factors, or benefit design changes within the products offered by these plans. Operating earnings for the plans in the first quarter totaled $11.6 billion, an increase of 29%, or by $2.6 billion. Average growth was 66.6%, with Centene as the leader with 305% growth. Medicaid plans in total reported operating earnings of $1.4 billion, an increase of 169%. Commercial plans had a $9.1 billion in operating earnings, an increase of 17%. United Health Group's operating earnings grew by $1.7 billion to $6.3 billion. The average operating margins for all plans decreased by 0.9% to 5.4%. Commercial plans posted a 2.4 percentage point decline to 6%. Medicaid plans had a gain of 0.9 percentage points to 4.1%. The health benefit ratio for all plans increased by 1.4 percentage points to 84%. Note that Sherlock Company's calculation of health benefit ratios excludes the impact of favorable and unfavorable prior period reserve development. When these development are announced, we remove them from the expenses recognized in the reporting period and then allocate them to the quarters in which these previously underestimated or overestimated expenses occurred. The average health benefit ratio for Medicaid plans increased by 0.9 percentage points to 82.1%. Commercial plans posted a 2.1 percentage point increase in their health benefit ratio to 83.9%. The administrative expense ratio decreased by 1.5 percentage points to 11%. Medicaid plans reported an average decrease of 1.9 percentage points to 13.3%, while commercial plans experienced a 1.8 percentage point decline to 13.5%. Cigna cited a portion of the decline in administrative expense ratio to the repeal of the health insurance tax imposed under the Affordable Care Act. The non-operating earnings increased by $622 million. Our calculation of non-operating income is the sum of investment earnings earned in non-health insurance lines of business, less business interest expenses. Medicaid plans reported a loss of $114 million for non-operating earnings compared to a loss in the prior quarter of $49 million. Commercial plans had an increase of $758 million to a total of $956 million. This was driven by Cigna's non-operating earnings of $584 million relative to the comparable quarter of $335 million. Strong performance by Cigna's PBM was responsible for this. Net earnings for the first quarter were higher for the plans, increasing by an average of 186% and in total by 43% to $9.5 billion. Medicaid plans had earnings of $925 million, a total increase of 271% and an average gain of 453%. Centene posted a gain of $697 million and an increase of 878%. Commercial plans generated $7.7 billion in net earnings, a total increase of 27%. I want to close by touching on a key environmental factor. As I noted at the outset, the capital markets have been highly permissive to initial public offerings of health plans. The new publicly traded health plans are Clover Health, Alignment Healthcare, Oscar Health, and InnovAge. Clover Health, Alignment Healthcare, and InnovAge all focus on Medicare, while Oscar Health is commercial-oriented. In all, these plans serve nearly 700,000 people and represent 0.5% of the total for the health plan universe. Clover Health focuses on Medicare and has 66,000 members, an increase of about 10,000 members year over year. They went public via a SPAC merger on January 8 of this year. Alignment Healthcare is a California-based health plan focusing on Medicare. Alignment has increased membership year over year by 19% to 84,000 members, plus it serves 600 people who receive subcapitations from other health plans. The company went public on March 26. InnovAge is a PACE plan, that is, Program of All-Inclusive Care for the Elderly, with centers in Colorado, California, New Mexico, Pennsylvania, and Virginia. InnovAge serves 6,655 members, paid for under capitation for the very broad spectrum of the care required for this population. Oscar Health is primarily a commercial plan with a total membership of 542,000 members, an increase of 29% year over year. Collectively, these plans have a market capitalization of $13 billion, representing 1.8% of the total for the universe. The price-to-sales ratio for the publicly traded health plans averages 9.6 times compared with 0.75 times for the continuous plans. Membership growth for this set of plans is 18% year over year as compared with 8.5% for the continuous plans, likely helping to inform their valuations. In addition, there are two plans that are going public very soon. Bright Health Group filed an S-1 on May 19th. Also, Jaws Acquisition Corp., a SPAC for Cano Health, will be meeting on June 2 to vote to approve a merger with Cano Health, effectively making Cano Health a publicly traded company. Bright and Cano serve 580,000 and 103,000 members respectively. Bright Health is focused on the commercial segment, and Cano Health is focused on the Medicare segment. We cannot know the reason for this permissive environment for health plan IPOs, but perhaps investors consider the present auspicious for changes in healthcare delivery. If health plans are conceived as the downstream end of a healthcare production chain that includes upstream health services like physician and hospital care, the emergence of innovative models of those services as public companies supports the thesis that investors think that the times are right for structural improvements in healthcare. These companies include Agilon Health, One Medical, Privia Health, and Oak Street Health. Agilon Health is a capitated primary care provider. One Medical is a subscription-based primary care provider. Privia Health provides medical services through medical groups, and Oak Street Health is a capitated Medicare primary care provider with health centers. They are relatively small organizations with a market capitalization of $31 billion compared with $711 billion for the health plan universe as a whole, but are linked with health plans. For example, Humana has more than a 5% interest in Oak Street Health, and Anthem has a 4% interest in Privia. Collectively, we are referring to these organizations as value-based care organizations. We think that value-based care organizations are sufficiently interesting that we intend to cover them. We haven't decided whether to include them as part of our Pulse newsletter or add a new newsletter in the future, but we expect to share more about what we learn about these organizations in the future. Finally, as an aside, the 2021 cycle of the Sherlock Benchmarks expense and operational studies are proceeding apace. We are still open to participants in the Medicare and Medicaid universes. Please let us know if this is of interest. You will be among good company. We also expect to summarize the results of the Blue and IPS universes in June and July in the Plan Management Navigator, which is free for the asking. Please let us know if you're interested in either participation or in the summaries. As always, you can get a transcript of these remarks through MCOL or through Sherlock Company. Again, they or we can point you in the direction of the two free website applications that we had noted in our previous talk to you about comparing the costs of your company and the effects of economies of scale. We look forward to hearing from you. This is Doug Sherlock of Sherlock Company.
You've been listening to Doug Sherlock shares quarterly insights into financial markets of health.